Good morning and welcome to our latest webinar. I think this one is very timely right now, given the economic landscape here in the States, a lot of reported slowdowns, a lot of inventory builds, etc. I'm excited today to once again present with my co-host, Don Hauser, who came from John Deere. And I thought we would kind of do something a little bit different today and kind of pose this fireside chat more as an actual Q&A and just get a better understanding of how Don did different things at Deere when faced with kind of a sluggish market, which we kind of went back and looked at our calendars and said that looked a little bit like a down market in 2016, and we'll add some other color to talk about down markets. Okay, a couple housekeeping items and then we'll get started. So first one, my colleague Jen is in the webinar now. She's in the chat as well. If you have any issues whatsoever, just drop a note in the chat. Also, our analyst team is joining us today and are secretly in the chat room with you. So if you have any other random question that you want to ask, just throw it into the chat. We will respond live the best we can. And anything we don't get to, we will follow up with you afterwards. So those are a couple of the housekeeping items. And with that, I will just get started. So Don, I was hoping you could kind of kick things off with what's happening in steel markets right now. It looks like, well, we're getting a lot of inbound calls about the rising metal price situation for steel. From your vantage point, what do you think is happening?
Well, it's clearly coming up, and it's coming up relatively sharp. I think you had a drawdown on inventories going into the end of last year, which is pretty standard. So you have that drawdown, and then you have a slow in demand also, and then it ramps up after the first of the year. People turn stuff back on, and you're building stuff. Demand gets a little stronger, and then price kind of starts to come up. I think you got some mills that got aggressive and helped push it up. So came up really fast, and it's continuing to come up. It probably has a little ways to go. I don't think there's a ton of runway left, but there is probably still some left to go before it kind of flattens out, and I would suspect comes back down. Anytime you see a skyrocketing price, you usually see a crash before that. You can look on any historical steel chart and see something similar to that. I think if you are forecasting based off of traditional supply and demand fundamentals, you're probably scratching your head a little bit trying to figure out, this price doesn't match what I'm seeing. Almost everybody I talk to has a slowing demand, building inventories, which doesn't exactly line up like you're doing. If you look at technicals like we do, there's some of that is a little better explained between some panic buying and just the way that the technicals perform the forecast. I think it's important to look at what's going on. Is that really long term or not? So that's kind of where we're at there. Speaking of long-term trend, or is there noise? We talk a lot about separating out noise from a trend and what to do with that information. You have any insights to that in this particular?
Sure. Happy to, and feel free to look at steel, but let's start with aluminum if you don't mind. You want to just chart, Don, and we'll kind of talk through what I'm talking about. So this is one of the things in general that we've seen a lot of panic buying, if you will. Or so if we look at just the last month, maybe is a good example here between March and kind of where we are today. Sort of at the down part where the aluminum price was closer to that support level. Yep, at that 22.85. There could be everything's calm, and then you see the prices ran up until, what was it? There you go, end of March to 23.94. They're off a little bit. Sometimes when prices start to run up, we see panic buys no matter what. And oftentimes it's really not indicative of much of anything unless you see that 15-day moving average. You see the price go up above that red line from a 15-day moving average perspective. And that's when, you trigger, quote, maybe it's a change in trend versus the noise. I mean, if you just look at this chart, it just looks like a bunch of up and down and more from a sideways perspective. I want to throw the 1 year just to kind of offer some comparison. So we're in sort of a gradually slower, right? It looks like we were more bullish earlier a year ago and kind of have been trading less sideways with the exception in the beginning of January through February. Don, I don't know if there's anything you wanted to add to that just from a steel perspective, or we can move on. Just let me know.
Well, not really from a steel perspective. You'll see something similar. Looking at this chart, it's traded about the same as it was clear back since July of last year. It's just kind of sideways, but it's easy to get caught in these ramp ups, these quick spikes, and it's really just noise. If you change your buying strategy the wrong way, you can really get burnt following
Exactly.
trends.
Exactly. Okay. So Don, I know you're hearing companies are telling you that they're feeling pressure from their suppliers to kind of buy now because of the recent bounce. I'm particularly talking about steel. Is it a sign you should or shouldn't be buying? And more specifically, how did you handle that at Deere?
Yeah, there is people that I'm talking to that are, hey, you should put your orders in. Get that anytime there's a ramp up. It's like they're trying to kind of generate that fear or panic buying. If you look back at all the decisions you've ever made, you probably never made any of them that were good based on fear, and buying metal is no different. A lot of the ramp up, the spike is caused by panic buying. It happens every time, and it's not just across steel, it's other metals, commodities, it's really anything in general. So typically, when you're being pressured to buy, it's probably a good time to think about holding off. It's kind of counterintuitive, and you have to take some of the emotion out of your strategies and your buying practices. But as a whole, that's not a good way to go. When I bought steel, there wasn't a whole lot of that. I did, most of my stuff was based on contracts, but you would get that towards the end of the year. In my situation, hey, you need to lock in this contract now. It's going to go up. This is going to happen. This is going to happen. Sometimes that was a good sign of maybe I should wait a little later in the year to execute some contracts. And it's kind of the same principle with buying spot metal now.
I would agree. So in a down market, just putting your steel procurement hat on, like, how did your job role actually change as a steel buyer in a down market? Like, what things were you doing differently that you weren't doing in, say, a rising or a more of a panicked market? Albeit this time we have rising steel prices in this recession or whatever slowdown.
Sure. So when you're when you're selling everything that you can make, the focus is on not shutting factories down, making sure you have material. And we saw that, last couple of years, lead times went way out, the furthest I've probably ever seen them. Material availability was a real issue. We even advised customers last year going into contract, you're going to have to forego some of your discounts and pricing that you've normally had to ensure supply. And that's how it is when you're in that really hot market. The whole focus is don't shut factories down, make sure you have material so you can build it. As things kind of fall off and demand gets softer, the ability to procure metal is kind of like the baseline. That's expected. You have to do that. But then the focus, like what you're really gauged on, what the pressure is really on cost reduction, keeping your margins, make sure you don't have that margin erosion, leak out, some of those type of things. So it's really heavily pushed into cost reduction.
Okay, makes sense. So, if and I know you and I have chatted offline about different companies where we've seen their months on hand inventory suddenly increase or, go from 6 months to 24 months or whatever we may have heard. How do you communicate to suppliers when you were negotiating annual contracts and you knew that your volumes were going to be lower the following year? Like, how did you handle that? Because obviously you mentioned the discounts. You want to make sure you probably don't lose that. So how'd you manage that?
Well, you usually have a couple different kinds of suppliers. You have your transactional suppliers and your relationship suppliers. Both of them, you kind of have to start at the same place, and it's sharing your forecast. Sometimes people are a little leery about sharing their forecast, especially bad news. When it's going up and up, it's easy to say, we're going to build more, we're going to build more, where's my discount? But sometimes people get a little squeamish about, well, my demand's down by half. They don't necessarily want to tell their suppliers, or they wait till the last minute because they put bad news off. It's a great way to get torched by your supplier, by the way. So you communicate early, even if it's bad news, and your partner suppliers will kind of come along with you, usually. So you should communicate that early and often as possible, because they want to know. They have planning cycles too that they're going through, so they want to make sure they know what's going on. And your really good partner suppliers will kind of ride that curve with you, not penalize you, as long as you didn't really stick it to them on the other end. That's a pendulum. It always swings. If somebody gets bloody on one swing, the other person is going to get it on the other end. Your transactional suppliers, you're just going to take it because you took from them on the other end. So you're going to lose some discounts and some pricing advantage, because that was built solely off of volume-based pricing versus kind of the relationship end of it. And you typically need both of those type of suppliers. You don't have the time or the resources to service all of those suppliers in a relationship manner. So you need some of those transactional suppliers too. You just have to kind of know who they are, what bucket they fall in, and how to treat both of them.
Makes sense. I'm going to take just a quick public service announcement to remind everybody to throw any questions into the chat. Again, anything related to anything metals or whatever, throw it in there. We'll attempt to address that. I also want to mention a couple other things. We are going to be sending out, and maybe even posting in this chat, we have kind of a resource white paper that's dovetails with this webinar. It's called Squeezing Out Costs in a Falling Demand Market, same name in the webinar. They'll throw out a couple other resources that we think might be helpful to you. The Art of Timing Your Buy, along with Should Cost Models, the Ultimate Savings Hack, which we haven't gotten to, but typically should cost models are excellent ways to work on your cost reduction initiative. So hopefully we'll get into that in a little bit. Okay, so we talked about, what do you communicate to suppliers when you know your volumes are going to be down? But in general, what do you do? What do you do if you're a small volume player, but it still represents a significant spend for your business, but you're not a deer, you're not being, you don't have hundreds of thousands or thousands of tons to kind of, throw around in the negotiation. What's your guidance for smaller suppliers with lower volumes, rather? It could be a big company, but with lower volumes.
Sure. It comes back to the relationships. That's really the only card you have in a down market if you have no volume. So were you a good customer in the rising market? Did you pay on time? Did you forecast on time? Did you do what you said you were going to do? Kind of the whole say-do ratio thing that I talk about a lot. I said my forecast was this. I said I was going to buy this. Did you do it? Or did you kind of scrape some off so you can play the market? What did you do? That's the best way to really manage as your schedules fall off is those relationships, those partner suppliers that you have. And then like I kind of alluded to earlier, the transactional ones are just going to stick it to you, and there's nothing you can do there. But it really comes down to, did you build that in your strategy going forward? Did you take the time when times were good for you? Did you really nurture those relationships and build something that can help you on the downturn? Or were you really opportunistic and kind of squeezed everything you could when you could?
Right. I'm just going to throw in, because I know in our conversations with a lot of prospects as well as with some clients, I've always been surprised at times by the sheer number of suppliers that a company has for a given category. I mean, sometimes it's ridiculous, right? We might see 10, 11 suppliers for like
Great point.
what you might say, this is like a nothing spend. You shouldn't have more than maybe two. How prevalent is that? Are we seeing a lot of opportunity to rationalize suppliers to get?
I would guess there's still some of it because it exploded so much, when nobody could find material anywhere and you were doing your Google supplier search, when it's sourced through Google,
That's
um,
right.
it expanded. And then as that need kind of goes away, a lot of times you don't go back and clean all that up. You might still have an old PO, you might have a blanket PO out there. They're still in the system. So as one buyer transitions to another job and then a new buyer backfills, he sees this list of suppliers, might not know which ones are actually best. So there's probably still some of that out there, and that always happens when there's that need for material and you expand your supply base. It's just not super common to go back and stick to the process and shrink that down. And kind of the other thing that you can look at is some of the softer things like payment terms too. Does that help you? Does that help you stretch some capital out? Can you get a discount? That works sometimes too. If your supplier, even if they're in a cash crunch and they need money faster, you can shrink your terms and get a bigger discount. That kind of helps you offset some of your volume sometimes.
I'm going to just piggyback onto what you talked about, some of these concepts from a working capital perspective. So we are also seeing companies who do importing figure out how can they work with their overseas suppliers. So typically a lot of importers take title from FOB when the material is delivered onto the boat and wherever it is. And so that's obviously increasing working capital. So companies are now looking, I think there's a lot more opportunity for supply chain finance and trade finance to adjust that so that they really aren't paying for that until the material hits the plant or hits the delivery point instead of the shipment point. And I think working capital is definitely something we're seeing a lot of companies take action around. So anyway,
I've seen that kind of expanded in like vendor management systems, things like that, where you'll have the inventory set up in your factory, but it doesn't hit your books until you're ready to consume it, until you pull it out of the bin or you drop the sheet in the laser, stuff like that. So some of those type of systems can kind of help you with some working capital too.
right. I'm seeing some of those initiatives now as well. Okay, let me, I just want to go back to something we talked about in terms of, you talk about relationship versus transactional mills, and there's probably also that at the service center level. How did you determine like who made the relationships and who was in the transactional bucket? Like who decided that or what went into that analysis?
How many cuss words were used in the negotiation process?
So,
But you can tell usually pretty early on in the process of who wants to be a partner, who wants to work on new projects with you, who wants to develop material with you, who wants to be there for you, and who's there to just sell you material because they have it and move on. So you talk to these people all the time, especially in the negotiation process. When you need something, do they really hammer you on it, or do they just kind of provide a little extra service and don't charge you for it? They kind of know in the back of their mind, if they're providing this extra service for free, that you're probably not going to hammer them in the negotiation process when you have the leverage too. Those are kind of some of the things that go back and forth. I know sometimes I would need material from a mill and call them up and they'd say, well, yeah, we got it and your price is double. That's a transactional supplier. And you never forget what, at least I never forgot. I don't think they do on the other end either. And when it swings back around, you swing the hammer and get it back on your end. It's not a good way to do business. It's just how it is. Those transactional suppliers are always going to be in there.
okay, and just, is there any other nuance for a service center with the same question, relationship versus transactional, compared to a mill, or is it the same?
Yeah, no, it's different because service centers are typically more relationship based just by nature because they're service centers, right? They're providing that service. That's a big part of what they do. And if you have all spot business, I think kind of by default you're going to get transactional type service. And then almost the other end is true too. If you have contractual business with service centers, I think they're going to try to kind of nurture that as a partnership and a relationship. It's just different business model at the service centers than the mills. You know, the mills don't really provide a ton of service. They provide material. So unless they're really trying to develop or build something with you, a lot of times that's a little more transactional in nature.
Great. Just I thought we can ask the folks on the call, or rather on this webinar, to go ahead and post. I'm curious, where you feel you have more of your relationships. Are they strategic? Are you guys buying mostly from mills, service centers? Just want to get a feel for that. And if you would just indicate the category of metal that you're in charge of, or looking at, or where you're on task for having to achieve some cost reduction around, just more for conversational purposes. And with that, I'll kind of move on to the next part of this. So, Don, talk to me about how you went about getting cost downs, both for steel and for fabricated or finished parts. I say the word finished parts because folks on the call are buying, cable that goes into electric utilities, for example. Other people are buying fabricated parts, etc. What was the process that you used to get cost downs?
Well, there's two prongs. There's the negotiation on your buy as a whole. So I have X amount of tons. I'm trying to go after some kind of discount volume based whatever that you're going after. And that's kind of an activity, really. Like once a year you negotiate that contract, or multi-year, depends on where you're at. There's that, and I think most people are familiar with that. It's kind of the easy, well-known one. Maybe not easy, but people are familiar with how to do that. And then there's the ongoing basis, the process driven cost management, cost reduction type activities. And that's really kind of dissecting your buy. So looking at, okay, I have these 15 parts and they're all kind of similar gauges, grades, width. They should cost the same, right? Do you have any outliers on there? Sometimes it might be as simple as you fat fingered a number when you put it in the system. Or it might just be you're getting taken advantage on something. It might be a one-time buy sometime that turned into production. There's a whole host of different things there. So I always kind of segmented it by material. And then I grouped it kind of the same activities for suppliers. So, I have this supplier, this range should be similar, and then volume too. There's always a break between your high volume and your low volume, but within those volume segments, you should be relatively close. Grade extras and things like that, I always kind of checked those to make sure those line up. You don't want to be paying more for one grade than the other. That's also a good piece to go negotiate with your suppliers on too. I always found that grade extras were the easiest, kind of softest place to negotiate. There's a lot of metrics and reporting around base numbers, but not so much on grade extras. A lot of times it would go through a different approval process, even within mills, to negotiate down on those grade extras. So that was kind of a big piece of where I would go after.
Okay, I'm just going to add, from an aluminum perspective, we've seen companies, especially if they have decent volumes or good mill orders, to negotiate that conversion premium. And it's important to benchmark that in falling markets as well, because sometimes you can achieve additional cost reduction on the conversion, even regardless of what the metal price is doing. And so I think and I'm going to make a plug for should cost models. And again, we have a white paper that we're posting here called Should Cost Models, the Ultimate Savings Hack. So even Dom, when you were talking about, you felt like the grade adders maybe were a little bit more soft in terms of, or there was more flexibility from a negotiation standpoint. having access to should cost models that kind of highlight those differences, I think can also be very helpful. So, and I know we have those here at Metal Miner along with the stainless steel should cost model, where those adders and extras make up a big percentage of the total costs. So appreciate you saying.
Another spot to look at is low volume. It's kind of another thing that's a little counterintuitive. It's kind of the forgotten spend. A lot of times you go after those really high runners and try to squeeze a nickel out of it. But if you have some of those low runners and you're squeezing dollars instead of nickels out of it, a lot of times it can add up. And most suppliers know that people aren't watching those low volumes with the same type of rigor. It's kind of like I said, the forgotten spend. So it really kind of ramps up, and especially in a down market when they're really trying to maximize their efficiencies on their end, a lot of times they'll ramp up that low volume cost. Kind of helps them with their internal margins, and it can get kind of slid in. So that's a good place to look at too. And then there's different strategies. What do you do with that too? I know a lot of times we had lifetime buys. So those low volume parts sometimes would be, a lot of times would be service parts. You'd project out how many years are you going to have that service part around? Is there another 15 years of life in that service part that you're guaranteed to your customers? Kind of figure out what that was going to be, and then issue a lifetime buy for your suppliers too, so they can get their efficiencies. You can ramp it up. You do have to hold that inventory then, but instead of 12 parts for 10 years, you get that 120 parts right now, but you can get it sometimes at a fraction of the cost of the 12. So sometimes that's good too. Like I said, the downside is you do have to hold inventory, which nobody's a big fan of. But
so you're saying on the 80-20 rule, which is sort of that famous Pareto principle that a lot of people like kind of look at their categories. You're just calling out, don't forget to look at those 20%, because that's what that's where you can get really hosed on this.
Absolutely. I mean, I definitely wouldn't advise you to start there, but at some point you're going to get most of the meat off the bone of your high volume. And where do you look next? There's a lot of times there's something to be said on the low volume.
Right. Okay. Another question, or thought on, can you just comment on the timing of last price adjustment with regard to asking for cost downs? Why is that important?
Yes, it's very important. So a lot of times, you're right now we're in an up market, right? So I suspect people
for steel.
For steel. I'm sorry, but it could be for any category. Be any category that's up. You get that immediately. Hey, it's up. I need an increase. But you need to look at the last time you took a price change. If it was long enough, say it was 6 months ago or 12 months, depending on when you made that, from your start point to now, even though the recent market has come up from your last price adjustment, you might actually have a down coming. And that happens a lot when you have the amount of turnover that we've seen too. That kind of gets lost if your processes aren't super stringent too. You have turnover. That buyer that did that price change and did it is gone now. And the new guy steps in. He doesn't know the last time it was done, possibly. So the last time you made that adjustment is important to know, that you can have the accurate price change, whether it's up or down, and the magnitude of that change. It's really based on when they get changed last.
Right. And then like the other piece we like to say is don't wait for next week to start on your cost reduction, because you're never going to have your clock go backwards. It's always from the date that you negotiate the cost down is when you're going to get the benefits. So
I've never seen a retroactive savings put through.
No, they don't exist. Okay. Again, throw out any last minute questions. Jen, do you want to just throw up I want to share with everybody some free resources on the Metal Miner website that I just want to let you know. First of all, we do a weekly newsletter. In that newsletter, we always include something that we never publish elsewhere. So it's a great resource. It's typically we're commenting on one big macroeconomic trend or a couple, and then something that's happening in the metals markets that week. If you're interested, if you're doing cost down, cost reduction projects, need access to should cost models, we also do a lot of correlation analysis. We're going to do a future webinar on that. Feel free to check out a demo on the Metal Miner Insights platform. All of our articles are free on Metal Miner, agmetalminer.com. So feel free to get those. And the other thing that might be helpful, we publish, it's kind of similar to the PMI indexes or the producer price indexes from the Department of Labor. We do, I think, 10 or 11 global monthly metal. They're basically metal price baskets. We have 3 industry specific baskets, one on the renewables, one on the automotive industry, and one on the construction market are sort of the end use. And they're really good to measure month over month price changes. And that would be a good first stop for you to take a look at to see what has changed over time and should I be getting or asking for cost downs right now. So I want to thank everybody. We've taken 30 minutes of your time. Hope you found some good insights and tips here today. And we look forward to seeing you at another LinkedIn Live event. Thanks so much. Take care.